I mean, our tradition here is we quickly introduce everybody at the table, just to make sure you know if you can't read all the name tags, which of course I can't from this distance, but so you have Adele Imtaz, the acting corporate services director, I think, and CIO, and Ms. Blair, Mr. Schenkelberg, and then Councillor Minns.
Welcome, good afternoon. Thank you for being here. I think we've all met before. Tracy Holland, Councillor Division 5.
Kelly Chamsick, nice.
Rhea Wallach, Division 9.
We, Brian Hall, Division 4.
Ashton Anderson, I reside in Division 3.
Joe Gerlach, Division 1.
Gary Cromwell, Division 6. Welcome.
And Councillor Kapitanek, who is Division 2, is unable to join us today. So the floor is yours.
All right, awesome. Well, thanks for having me here today. Don't know if my presentation's up or how you want to do this, but
Yeah.
okay.
Sorry, it's not there.
No, it's all right. You want me to come over there?
I'll bring it to you. Right.
Okay.
Share the screen here.
Thank you very much. Okay. All right. Well, thanks for having me here this afternoon to discuss the our financial results and the financial statements for Athabasca County for December 31, 2023. So usually to begin these presentations, I like to do a bit of an overview of an audit. So why we have an audit and the importance of it. And really it's to enhance the degree of confidence of the intended users of those financial statements. So the main users being yourselves as councillors, ratepayers, the province of Alberta, municipal affairs. So those organizations or individuals with a vested interest in the financial performance of the county. This is achieved by us as auditors expressing an opinion. So to do that, we give assurance that the numbers are free from a material misstatement. So what that means is that as auditors, we're seeking reasonable assurance. So it's a high level of assurance, but it's not absolute. So we're not auditing every transaction that happened during the year. As auditors, we also exercise professional skepticism, we exercise professional judgment and maintain professional skepticism. So we're staying alert to conditions which may indicate possible misstatements. So areas such as cutoff, we want to make sure that transactions have been recorded in the correct fiscal period. Looking at your revenue recognition as a high risk area, you want to make sure revenue is being recognized once services or any performance obligations have been met. And then collectability of accounts receivable. So are your receivables at your end deemed to be collectible, or should there be an allowance associated with any of those? And then a critical assessment of the audit evidence we're looking at. So has anything been altered? Did we obtain information from a third party or directly from the county management? So when it comes to our audit report, so on there, page 3 and 4 of the financial statements, we give our independent or opinion here at the top, which outlines that the financial statements present fairly in all material respects the financial position, results of operations in accordance with Canadian public sector accounting standards. So those are the accounting standards that all government organizations report under across Canada. When it comes to the basis for opinion, we indicate here that we conducted our audit in accordance with Canadian generally accepted auditing standards. So auditing standards too are the same across Canada, but they're reflective of all organizations, whether you're a publicly traded company or a not-for-profit or a local government. Auditing standards are always the same. It's the reporting framework with the opinion that can be different. When it comes to responsibility and management, those charged with governance for the preparation and fair presentation of the financial statement. And then the last part of the auditor's report, we outline our responsibilities, which in turn summarizes our objective, which is to obtain reasonable assurance that the financial statements are free from material misstatements. So with that said, I'll go over some financial highlights for the year for the county here. So you'll see a snapshot here of your statement of financial position. You'll see your cash and temporary investments were up about 8.5 million, up to 35.6 from 27 the prior year. So you had generated $14 million in your operating activities and spent about 5.8 million on tangible capital assets. So that resulted in the change in your cash. When it comes to taxes and grants in place of taxes, so at year end, you had 606,000 here, so 691,000 in relation to current taxes, and as well as 1.377 in relation to taxes that are in arrears. And there's allowance associated with those totaling 1.46 million there. When it comes to trade and other receivables, provincial and federal grant receivables up to 8.8 million. So that includes MSI Capital 5.8, Canada Community Building Fund of 964, disaster recovery funding, and as well as STIP funding of 1.5 million. So grants that have been, you've incurred the expenses in the year or the tangible capital asset cost, but yet to collect the funding associated with those projects. When it comes to trade and other receivables, that was up slightly to 800,000, and then receivables from other government, which contains GST as well as other local government receivables there. So then turn total receivables up to 10 million versus 3.3 or a $6.7 million increase there. Back to the statement of financial position, land held for resale of 132,000, and then the total of all those leave you with a financial asset position of 46.3 million, or a $15 million increase from prior year's 31 million. When it comes to accounts payable and accrued liabilities, so what the county still owed subsequent to year end, about 4.9 million in accounts payable, about 4.3 million of general trade, and then 600,000 owed to other governments. When it comes to deferred revenue, so these are grants that you've collected in the year, but have yet to apply to a project. So you got 3.2 million for future periods. You'll see your MSI funding there, additions that contains 2021, 22, and 2023. Canada Community Building Fund, same thing, contains 3 years there. And then your revenue recognition. So what was recognized with those funds, you'd recognize revenue for MSI as you'd purchased 4 graders in the year, making up the bulk of that, and as well as your Alberta transportation funding for various bridge file work in the year for 2.7 million. Back to the statement of financial position, you'll see your employee benefit obligations here up to 700,000 in relation to vacation and sick accrual payments there. And then the new item for the year is asset retirement obligations. So the county adopted public sector 3280 in the year in relation to reporting your asset retirement obligations. So that contains lagoons, buildings, fuel tanks, so items located in the county that have an additional environmental. Yep.
So that's really a movement though from other, because we actually included that in the financial statements last year, right? Under a different heading. Is that fair?
Well, previously you would have had a liability, I think, for your gravel pits there as well, which are included in this, but
So it's, okay.
it was under a different section of the handbook. So this section's new, which is why you're seeing all the municipalities adopt this year. But that amount from last year does wrap up into the asset retirement obligations now. Yeah.
Thank you.
Yep. But yeah, and then they're calculated a bit differently, but so those are included in there as well. So the county used the present value technique to indicate the value as of today to be 7.8 million. There's future undiscounted cash flows of that of 10.4. So what we do is we take the cost, we future value it out for when it's expected to settle, which is between the years 2024 and 2045 currently based on estimates. And then we present value them back using a discount rate or a lending rate to give you today's cost. So if you were to retire all these today, that would be your cost. But because you're not, as it goes into the future, there's an additional expense every year that gets added to your operations as that liability increases. And that's called your accretion expense, is what you'll see in your operations. It kind of works the opposite of your amortization expense for TCA, or well, not the opposite, the same way, as it's a non-cash item that goes through your operations, and it just again, this one will increase the liability. So in the future, when you look to retire these assets, at that point, if you do retire them, the costs associated with that will go to reduce the liability versus going against your bottom line on your statement of operations. So, and again, these liabilities or retirements, it's not that they didn't exist before they did, they just weren't reflected on your financial statements. So in the future, again, when you go to retire a building with asbestos or a potential lagoon or a gravel pit, the costs are there, right? So now they're just reflected on your statement. Yep. Yeah.
Question here.
Thank you. So if what we're talking about is these liabilities appreciating through the years, the contaminated sites under liabilities up there seem to stay the same for 2022 and 2023. Can we expect that to appreciate for the 2024 statement?
Yeah, the contaminated site is actually a nuisance ground near Elscott or whatever, but that should be adjusted for inflation every year because the amount is not significant to the town or the county's financial statement. It wasn't adjusted, and we didn't make a recommendation to adjust it either because the amount increase was so
But
small.
theoretically, we would
But
see it
theoretically, yeah,
increasing.
it should increase slightly every year just due to inflation. Is right now how the contaminated site would go up.
Thank you.
Yeah. Okay. And then, so that's the past retirement obligation of contaminated sites. Your debt limits, obviously you have no debt, currently, but your debt limits are calculated at 1.5 times your total operating revenue. So you have 55 million there available. And then your debt servicing limit is 0.25 times your operating revenue, which is how much servicing on the debt. So interest and principal you can repay every year, and that's at 9 million. So if you were to take your total financial assets less your liabilities of 19.5, you end up with a net financial asset position of 26.8 million or $11.5 million increase year over year. So that would mean that you have sufficient financial assets to meet all your current liabilities that you do have. When it comes to non-financial assets, your tangible capital assets of 82.8. Sorry, the slide needs some changes, but your opening balance should be 82 million, not 236. It's shown there. Your additions in the year were 6.9 million. So under engineered structures, you have various bridge file work as well as bridge culvert in there, machinery and equipment in relation to the 4 graders, as well as the 1 excavator that was purchased in the year. And then you also see the disposals in your machinery and equipment as you dispose of your previous graders and excavator that were being used. When it comes to amortization expense, it should be 5.5 million, and that represents the usage of your assets in the year. So during the year, you would, as you purchase assets, they last 5 years, 10 years, 20 years. You take a percentage of that, it goes into operations. So again, your expense this year is 5.7. You added about 7 million in addition. So you're seeing an increase to your assets or a replacement of those assets in the year. When it comes to the statement of financial position, again, non-financial assets, inventory for consumption. So gravel inventory there, 1.6 million, and as well as equipment, parts, and chemicals there of 750,000 make up the difference. So that left you with total non-financial assets of 85.7. So if you were to take that number and add in your net financial asset position, you'd end up with an accumulated surplus of 112 million. Year over year change there of 11.1, which is actually your annual surplus for the year. So your accumulated surplus of 112 is made up of 2 parts. Your unrestricted and restricted surplus make up 37.5 million. And then your tangible capital asset component make up 75. So of that number, 37.5 is related to a cash component, and the other part is related to is tied up in your assets. So with an $11.1 million change year over year, you actually see that change in your unrestricted and restricted surplus amount as your TCA decreased about 74,000. So the entirety of your annual surplus this year is actually an increase to your unrestricted and restricted, not in relation to a change in your capital. Sometimes you'll see your annual surplus will be a larger amount, but it could be because of a bunch of capital grants either being recognized, but in this case, it's in relation to your operations. So the next slide here, start on your statement of operations. So this shows your operating revenue for the year. You'll see your net municipal taxes were up to 28.4 million from 22.4, about 26% change. So 13% in non-residential rate, 2% for residential rate, and as well as the remaining being an increase in your assessment value. When it comes to government transfer operating, that was up to 2.6 from 1.6 as you had additional disaster recovery funding there of 600,000. As well as your ACP grant, Alberta Community Partnership there of 372. When it comes to user fees and sales of goods, that was up as well. You saw additional water and sewer revenue as well as recreation revenue associated with the consolidation of the multiplex. And then investment income up to 1.7 from 726. So as interest rates have risen for this year, you're also seeing a greater rate of return on your cash and temporary investments that you do have. Yep.
Jeff, do you, sorry, would you please be back up? You made the comment about user fees and sales of goods along with the
Yeah, yeah.
consolidation of multiplex. So
Yeah.
the county owns the building, but we don't. Like the revenue from the other society's operation is not our revenue.
Yeah, there's revenue and expense component that comes across as you own, I think you own 50% of the operations there or
And so
fund them,
we're
right?
required to
Yeah.
blend that into our statements here.
Yeah, so that comes in. So we were able to obtain a draft statement before that will allow us to adjust our amounts in the statements to get a more accurate reflection of that. But yeah, the operations do come in.
Thank you.
They do net out though, because you either fund the deficit or you don't, but they're shown on a gross basis across there. And I think they're reflected in note 19 on the financial statements there is where you would see amounts there coming through. So,
Thank you.
yep. There you also saw some additional other revenue in the year. You had some insurance claim and also donations you were collecting from the multiplex pool there. So that comes through on a gross basis as well. And that left you with total revenues of the year of 36.6 million or $8 million increase from prior year. And as well as over budget there by about 3 million. So increase in the operating revenues. This pie chart here just gives you a percentage breakdown of where your funds come from there. So really net municipal property taxes make up 77%. Last year it was 82, so it is down as a whole of the pie. Government transfer operating at 7, it was 6 last year, and then investment income was up this year up to 5 from 3 in the prior year. Expenses by function here. So what the operating revenue was spent on. Transportation services were up to 16.2 from 14.7. You saw additional road maintenance, equipment usage, and engineering costs in there. General admin services, you had an increase in wages as well as IT costs year over year there. Protective services, that includes your disaster recovery funding. So you had the additional revenue that came in, and then the costs were associated into that category there. And then planning and development had additional wages and FTE there up to 1.6 from 1.3. That left you again with total expense of 31.2 or a $2.8 million increase year over year. So when it comes to comparing to the budget here, you'll see this chart here. The line represents your budget. And then the bar graph, the dark blue represents your current year. So you'll see your budget is either at or just above all the categories there. The only difference is in relation to the recreation costs, which I think would affects the multiplex consolidation there, but everything else is at or below the budget amounts. When it comes to expenses by object, so a different look at the expenses here. Your salaries, wages, and benefits up to 10.4 from 9.3. So additional FTE and filling of positions there. Contract and general services were up in relation to engineer and consulting costs. And then, and as well as additional police funding there. Amortization of 5.5, materials, goods, and services of 4.4 million. And again, 31.2 in total expenses. So if you take your total operating revenue less your operating expenses, you end up with an annual surplus there of 5.4 million. The government transfers for capital here, 5.6 includes MSI, STIP funding, and Canada Community Building Fund. So total other income plus operating surplus equals 11.1 million for an annual surplus of the division. You see there's a restatement here for 1.2 million in relation to your asset retirement obligation amount that got restated. So we used a modified retroactive restatement approach, which was what was also provided as guidance to municipal affairs. So what that means is as of January 1, 2022, your initial liability was booked and the offset went to your accumulated surplus as a reduction. And then in 2022, you have an accretion expense. And as well as in 2023, an accretion expense, which shows the increase in that asset retirement obligation from the opening amount. The other method would have been to do a prospective method where you would have had a direct expense on your operations versus adjusting against accumulated surplus. So the modified retroactive restatement approach was pretty common and used. So it doesn't affect. In essence, it doesn't really change what your operations were for the year, just the accretion expense from the change as opposed to a direct impact. So in summary, the county ended up with an annual surplus of 11.1 million versus 1.8 million the prior year. Net financial asset position up to 26.8. So you have sufficient financial assets to meet your obligations. There's also an audit finance report. We'll talk about the restatement for ARO as well as a disaster recovery program grant receivable that was booked from 2020. But we had no significant control deficiencies or unusual accounting policies. We have some unrecorded misstatements in our report as well, and no significant difficulties to note to council. Just wanted to thank the team for all their help. If anybody has any questions on this before I jump into the other report, I can definitely take them.
Counselor Holland, sorry.
Thank you. Uncorrected misstatements. Can I get a bit of a definition on that one, please? Just because
Yeah.
it just is, I'm looking at it going, what does that mean?
Oh, yeah. So when we're performing our audit work, sometimes we'll identify items that we feel that I guess the correct amount isn't reported, so it should be different. So that could be potentially additional accrual or some other change to the statements, but those amounts are not necessarily significant in nature to the county's overall position. So they either elected to not be reported within the financial statements, then they just get presented on our unrecorded misstatement schedule. So those are adjustments that are not reflected in your statement versus adjustments that are reflected. So, and sometimes majority of them have to do with timing. Sometimes where something that happens in this year that maybe should have been a prior year, but it's not of again material nature. So we're just not restating for that amount, but yeah.
And at other meetings, I've been present with you. Jeff has explained the threshold, the calculate, like
Material.
some things are so minor, they don't.
So it all kind of depends. Sometimes management doesn't want to make those entries or whatever, but yeah.
Other questions? You're gonna go on to the financial statement. So what you have another report?
Well, I have the audit findings report. I don't know if I can't remember if I do that one in camera here or if I do
think
that
we're gonna do
live.
that one in camera.
Okay.
That's one,
With the pen on the
I think we
top.
should do
Yeah.
that one in
Yeah.
camera. Because of the questions, unless the CIO has different advice, no. On this one, the questions that I think come from open for me, if we talked about the trade and other receivables, there's a fairly significant change year over year.
Mhm.
Is that because of slowing down, like, is the aging increasing, or is it,
The trade receivable amount for
Yeah.
the grants.
like, are there any concerns about the receivables aging?
Yeah, you're gonna want to apply for your grants so you can collect the money. So the expected work that you want to do on those programs has been done. You just need to finish your application to the province to get the money for those programs.
And then as it relates to the trade and other, that's our accounts payable and accounts receivable, those, it looks like have increased as well. Is that again related to just more volume, or is the aging getting worse?
Well, the receivables is just mainly in relation to the grant funding through the province of Alberta that you're going to want to apply for. And then the accounts payable items, they were in relation to just more volume, more work at year end. So about 4.3 million versus 3.8 in the trade side. And then you had more money owing to other governments in relation to liabilities at year end.
That's right.
I have a question regarding Schedule 3 of the audited financial statement. Under requisitions,
Do you want to give just a page number for the rest of council to
sorry.
catch up?
so this is page 10 of the financial statement, page 102 of our agenda package.
102 of the agenda package.
Looks like it should-
Under requisitions, the Greater North Foundation, the seniors lodging. It says that our budgeted value for 2023 was only 82,000, and yet the actual was 287, which actually
Yep.
is more in line with the 2022 value. And then the designated industrial property is budgeted at 267.5,
Yeah.
and the actual was 95.
Yeah, it does look like those should probably be flipped. We
Is
could
that
take,
just
we could take a look at that
error
and
in
make
the
sure.
financial statement, or
It could be, yeah.
was it something in our budgeting process that you picked up?
Well, these are, I would, off the top of my head, I wouldn't know, but usually we are pulling the accounts based on that the budget is tied to, but we can take a look
Okay.
and see from the actual approved budget if maybe the amount was in the wrong account and should have been the other one, but
Requisition wouldn't be in the approved budget, but I can confirm the Greater North requisition would have been in the more, I think those are
Yeah.
just.
yeah,
on the
I
wrong
think they need to be flipped, but yeah,
Okay.
usually they're coming. It's so when we get a GL account, it's got an actual amount in it, a budget amount. And it could have just been that the amounts
just be
needed to be in the
something they
different
thought.
ones. Yeah, for
Okay,
sure. But
wonderful.
thanks for knowing that. We'll definitely make that change before we issue the final ones.
So in the first half of the presentation, this is again, page 17 of the council agenda. The employee benefit obligation, the 713. What changed to go from 448,000 last year to 713? Can you just,
Your vacation accrual did.
so we weren't doing it last year or like,
It
Or
just
you-
wasn't paid out. So people were working and accruing more vacation.
so over the span of 1 year, we've had a $300,000.
Yeah, it'll be in the other report too. We can talk in more detail there, but yeah.
Thank you.
You bet.
Any more further questions on this first half of the report? Looks like none, so we're gonna move to the second report that's farther on in the agenda. You'll bear with everybody for catching up in their pay package. So this is the one, this is immediately after the financial statements and starts around page 120 of the agenda. One, two, 120 or 120, yeah, 120. So this is the one, the CIO Beck, I think, in order to do some of the questions and the. Is this something we should be presenting in closed for the conversation and the questions, or is it?
This is part of it.
It's in the open part of the agenda. I think some of the questions and the discussion should happen.
There's a portion and then typically a council would go into section.
So we'll do the open session first, folks, and then if the questions are really specific, we can. There'll be a closed session after too. Again, thank you, Jeff. The floor is yours.
Yeah, no problem. Are you? Do you want me just to read or do you want to put it up or?
Sorry.
Sorry.
I. Which one did I have?
Oh, yeah, no, okay. I don't know, does this work or? Oh, yeah, okay. Awesome. Okay, so this is our audit findings report. So kind of the qualitative part of our section here. So really the purpose of this report is to promote two-way communication between ourselves as the auditors and yourselves as counselors. So effectively, as of today's date, we'll complete our subsequent event procedures. We'll obtain a signed management representation letter. We'll complete required communication to council, which is what we're doing right now. And then we'll obtain evidence of council's approval of the financial statement. Once those are all done, we'll be able to issue signed audited financial statements. When it comes to changes from our audit plan, the only change is in relation to our materiality. So we initially set our materiality based on prior year actuals. And then as we begin our audit, we adjust to the current year amounts that we had. So in turn there, we use 4% of operating expenses, or roughly $1 million, as a materiality level for the county. So what we're saying here is that if your revenues or expenses were to increase or decrease by $1 million, we feel that a user of the financial statement may have a different view or outlook on the financial performance of the county. So again, users being yourselves as counselors, municipal affairs, those organizations with a vested interest there. When it comes to our engagement team, so myself and Achia, I'm responsible for the work that our firm provided to the county here. When it comes to audit results, so here I'll just touch on a few of the items here. First one here, management override of control. So management is in a unique position to potentially perpetrate or manipulate the financial statements through adjusting journal entries, whether through fraud or error. So we use data analytic tools that identify specific journal entries within the GL. We then test those journal entries to ensure that they are valid business entries. So again, looking for certain items that may be indicative of possible misstatements. So we had no significant findings in that area. When it comes to revenue recognition, such as grant funding, we want to make sure revenue is being recognized once performance obligations have been met there. So we have noticed some findings there that we've noted in our other matters section of our report. Other areas of note here, so operating expenses, here we want to make sure that expenses have been recorded in the correct period and that they are actual valid county expenses. So we've noticed some other matters there, and as well as salaries, wages, and benefits, including your employee benefit obligation. We've identified some items or findings there in our other matters section as well. When it comes to receivable balances here, so we did have a restatement in the year where it came to the disaster recovery funding as the county was incurring costs related to that. And then the application was kind of being done in the current year, although the receivable should have been booked back in the 2020 fiscal period. When it comes to tangible capital assets, so this kind of is obviously a big section of your statement of financial position. So here our risk is that you have items that are in capital that don't actually meet the definition of that. You have items that have been expensed that should be in capital, or you have assets that are potentially impaired that should be written down. So here we're looking at your tangible capital asset policy. We're testing significant additions and disposals. We're looking to recalculate your amortization and gain loss schedule, and as well as we want to look at how you're funding these assets. So you fund them through tax revenue, reserves, and or grants, what's approved in your budget, and we want to make sure that that's in line with what's been approved there. So we do have a restatement in the year just in relation to the asset retirement obligation additions there for tangible capital assets. And then the last one here really is your asset retirement obligation. So obviously a new section for the year. Really completeness of this is a big risk. So do we have all the asset retirement obligations of the county? What kind of work was done? So assessing the controls over the work, the scoping of the work that the county did, where the estimates came from, are they valid third-party estimates, and then also adjusting the calculations to make sure those are accurate. So we didn't have any findings there. We're just noting that obviously the restatement for the year, but we feel that your asset retirement obligation amount is good there. So when it comes to adjustments in the year, so we made 31 adjusting entries from when we began our work versus 6 in the prior year. It resulted in an increase of your assets of 2.8 million, decrease the liabilities of 2.4, decrease your accumulated surplus of 1.2, and then an increase your annual surplus of 804,000. In addition to that, there were management entries that were made once we began our work, about 16 of those. After the initial trial balance was begun. So a lot of entries were being made after we had began our audit. When it comes to unrecorded misstatements, so here we noted an understatement of about 65,000, a few items here. So accruals for year end related to payroll liability for employees paid between December 21st and 23rd. So increasing your liability there. Record correction or record correction of fiscal year 2022 over under levy. Also record the net asset pickup of the multiplex consolidation. So in prior years, we haven't had exactly information readily available. So this year, the statements were a lot more complete. So we were able to pick up all the components of this year, and as well as there was additional amounts that wouldn't have been in the prior year statement that were recognized this year in relation to 187,000. And then also a carry forward of the FRIA grant here. So in effect, the net effect on the bottom line is that the county surplus is understated, should say 65,057, not 67 there, but in relation to the financial statements. So with materiality at $1 million, we don't feel that these adjustments are going to change anyone's opinion of the financial performance of the county if they were recorded or not. When it comes to your restatements, so there's 2 here. So the restatement for the disaster recovery program in relation to the additional receivable for funding there, and as well as your asset retirement obligations. The main one being at the bottom here, your decrease in opening accumulated surplus of 4.1 million, and then the decrease in your gravel reclamation of 7.7, which was there previously. And then, sorry. I didn't flick that. Yeah. And then the increase of your asset retirement obligation of 7.4 million there. When it comes to your control environment and other observations, so we have not identified any significant control deficiencies. When it comes to significant qualitative aspects or accounting policies, again, the adoption of asset retirement obligations effectively for January 1, 2023. So the county had applied the modified retroactive restatement approach, and this is also reflected in note 24 of the financial statements. There were no other initial sections or changes of significant accounting policies in relation to this one. When it comes to significant your accounting estimates, we feel your estimates are in line. So your allowance, useful life of TCA, your accretion on your ARO. So we feel that your estimates are good. And then we'll also issue a management letter to management in relation to non-significant items that we had noted while performing our work. So when it comes to other matters, so in relation to revenue recognition, so we had noted that no revenue in relation to MSI, Canada Community Building Fund grants, were expensed in the year. So this resulted in an understatement of the county's surplus. So additionally, projects reporting for MSI and CCBF have been delayed resulting in the county not being able to receive its annual allocation of funds since 2021. So it has been issued by the government of Alberta. MSI will be replaced in the year 2024, 2025. Any capital funding not spent within 5 years after the funding was allocated must be returned to the province. So delays in project reporting could result in the county losing its MSI capital allocation, or the county could potentially be obligated to pay back significant amounts. So we're recommending that you possibly get that caught up and to get your funds. This is what the receivable is for. When it comes to accrued receivables and accrued liabilities here, so we noted no adjustments were made in 2023 for accrued receivables or accrued liabilities outside of reversal of prior years. So again, this could result in understatement of revenues and expenses and misstatements here. So we're asking that accruals be booked. When it comes to your reserves, we noted no adjustments there in relation to your 2023 transfer budget reserves. So again, this was adjusted for within the financial statements. And then your employee benefit obligation in relation to your vacation accrual, as you see a larger increase year over year. So based on your policy, you're not supposed to have employees over 2 years of holidays. We had tested the larger ones and noted that you have a number of employees or a few employees that do exceed that amount. That resulted in a 59% increase in employee benefit obligation year over year. So those are our other matters. When it comes to appendices, so just our required communication here on Appendix 1, we do not hold a financial interest, position, business or personal or business relationship or economic dependence on the county to maintain our independence there. We have our management representation letter that we'll get a signed copy of, and then we'll be able to issue signed audit financial statements. And then our last part here is Appendix 3, where we discuss new and revised accounting standards. So there are 3 new accounting standards for next year. Public Sector 3400 revenue will have some additional disclosure requirements for the county's financial statement. And then 4 years from now, December 31, 2027, you will see a change in your financial statement presentation. So what will happen is you currently have financial assets. Your non-financial assets will move from the bottom of your financial statement up to the top. So you'll have financial assets, then you'll have non-financial assets, and you'll have total assets. You'll then have financial liabilities, non-financial liabilities, and then net assets. Those two, or the liabilities plus net assets, will then total up and agree to your current asset position. So you'll see a traditional balance sheet approach on your financial statements. You will then see a statement of financial asset position. That'll take your financial assets less your financial liabilities. You'll have a statement of operations as you currently do, and then you'll have a net asset schedule, which will break out your accumulated surplus between your unrestricted, restricted, and equity and TCA, and as well as a remeasurement gain loss schedule, which currently doesn't affect you as you don't have any investments that are tied up to that have any fair value component or liabilities that is due as well. But if you ever did, you would see an adjustment for that. So those are the changes coming down 4 years from now in relation to your financial statement presentation, which will change again. This will be the second change for me since I've been doing these, but yeah. So, and that's it for our audit findings report. I guess if anybody has any questions, I can definitely take those.
Colleagues, questions? I have a couple, but I think I want to reserve those for closed session. If there are no questions from council on the presentation so far, it would be appropriate, maybe Councillor Gerlich will move that we'll go into closed session. Councillor Gerlich has moved a motion to go into closed session. On the adoption of the motion, all those in favor? Opposed? The count is 8-0 and the motion is adopted. Again, that without management present.
Good go.
Can you unmute it? Are we unmuted? All right, we left closed session at 2:28 on a motion from Councillor Gerlich. The count was 8-0. It is, we finished 4.3 on the agenda. The items left for discussion are number 7.5. Councillor Anderson, you're gonna make a motion to, or it would make sense to have a motion to accept the financial statement? Is it to adopt? Approve. With the exception of that one correction around the Greater North.
Oh, yeah, for the budget there, yeah, we'll change those on the final for sure.
So to approve the amended. Councillor Anderson moved that the council approve the 2023 financial statements as amended. Is there any further discussion? Seeing none on the question of the adoption of the motion, all those in favor? Opposed? Count is 8-0 and that motion is adopted. There's one further motion that's not quite on your agenda, but Councillor Anderson is going to make a motion to accept the improved consulting presentation for information. Councillor Anderson has moved, we accept the presentation from improved consulting for information. I missed that when the agenda was set up. Is there any further discussion? Accept, receive. What do you like better? You okay with receive? To receive the presentation from improved consulting for information on the question of the adoption of the motion to accept, to receive the presentation from improved consulting for information. All those in favor? Opposed? The count is 9-0 and the motion is adopted. CAO, pardon me? 8-0. CO Beck, was there anything remaining under 11.1 that we didn't cover that's imperative you covered with us today?
No, Mr. Chairman.
So 11.1 was just information without requiring any actions. Is there someone willing to move that we receive that for information? Councillor Cromwell has moved, we receive the CAO's presentation for information. On the question of the adoption of that motion, all those in favor? Opposed? The count is 8-0 and the motion is adopted. There is no further business on our agenda. Therefore, the meeting is adjourned at 2:33 p.m. Mr. Allison, thank you for joining us today.
And